Okay. Just share my screen. Very clumsy today at the moment. Okay, let's see. Okay, there we go.
Okay, that looks great.
Thank you.
Very official.
Well, thank God you didn't see my desktop. As I said, that is covered with files. But thank you for extending this invitation to me, and thank you for hosting this presentation on college loans. My name is Jonathan Hughes. I work for MEFA. And before we get started talking about college loans, sometimes we call this presentation Comparing College Loans. Sometimes we call it What You Need to Know About Student Loans. And I know it's a really popular topic, and it's one that is on the minds of a lot of students these days. And we'll get all into it. But before I do that, I want to talk to you about MEFA. And MEFA is the Massachusetts Educational Financing Authority. We are a not-for-profit authority. We were created back in 1982 by the Massachusetts State Legislature. And we have a public service mission to help Massachusetts families to plan, save, and pay for college. And we do that in a number of ways. What we were created to do actually was to offer a loan. And that's something that we still do. It's called the MEFA loan. And it's a low-cost fixed interest rate loan. However, since 1982, as the cost of college has continued to rise, simply offering a loan was not really sufficient to fulfill our public service mission. So we added two savings programs, the U-Plan prepaid tuition program and the U-Fund, which is the Massachusetts 529 plan. And a lot of what we do is kind of what I'm doing right now, which is outreach and education on topics like saving for college, financial aid, college admissions, paying for college, and comparing college loans. So I mention all this really just to say that wherever you're seeing this, if you have any questions regarding how to pay for college or college loans or anything regarding your education, you can contact MEFA. We're a free resource, and we have a bench of college guidance experts that are, as I said, experts in all facets. And if we can't get you that information, we can put you through to the people who can help you best. But I want you to think of us as a free resource and to take advantage of that free resource. You can call us, you can email us, you can sign up for emails, you can visit the website, you can find us on social media, all this stuff. And we'll go over that a little bit at the end today. Now, today, what we'll talk about, first of all, is loan terminology. So this is the first thing I think that people really get confused about. And I remember when I started working at MEFA, I didn't really know very much about student loans. And it was something that I had to learn. And I had to learn that as somebody who worked at MEFA and for my own borrowing when it comes to educational loans that I had. We'll talk about wise borrowing. So, the fact is that many, if not most, students or families will borrow something to get through 2, 4, or more years of college. And, that in and of itself doesn't have to be a problem. The problem becomes, of course, when people borrow more than they can afford to pay back, or borrow more than they absolutely need to borrow. So within that section of wise borrowing, we talk about, of course, minimizing debt, talk about federal direct loans, and that's something that we will talk about in some detail, because one of the very few things that we say that everybody should do is, if you're going to be borrowing anything for college, that you start by taking those federal student loans first. We'll talk about some loan details, and you heard the expression, the devil is in the details. The details are really important when it comes to educational loans. We'll talk about loan affordability, and we always like to talk about trusted resources. So this can be an overwhelming topic, but there are a lot of resources available to help you for free. MEFA is one of them. The folks at your TRIO office is one as well, and your financial aid office at MWCC also. And then finally, talking about the timing of some of these loans. And some of these things, are going to be probably more of interest to you than others. But again, if you have questions, you can definitely reach out to us on anything. So the first thing we talk about is understanding loan terminology. And when we talk about loan terms, the first thing that most people think of, or the first thing that they encounter when they're looking, is interest rate. And so, and when I tell you that, when I started working at MEFA, I had student loans. I had just graduated from college. I didn't know anything about student loans or interest rates or anything like that. So the interest rate, basically what it is, and if you don't know what it is, that's why I'm telling you, there's no real reason that people should know what an interest rate is until they have to. But basically, it's a percentage of the amount of money that they borrowed, that the lender, so who they borrow the money from, is charging you to borrow that money. So, if you borrow $10,000, you have to pay it back. You're going to end up paying back more than $10,000. A lender is going to charge you for borrowing the money. So the interest rate is what you're paying back on top of what you borrowed. So a low interest rate is, of course, better than a high interest rate, because it means you're paying back less if you have a lower interest rate. Now, the first thing to understand about interest rates are, especially when it comes to educational loans, they come in two varieties: fixed interest rates and variable interest rates. Fixed interest rates are always going to be at what you borrowed them at. So you have a 5% interest rate on your loan. It's not going to change. It's always going to be 5%. So this is attractive to a lot of people because it's not subject to the way the economy or the market might go up and down. You always know what it's going to be. You're repaying it. You always know probably what your monthly payment is going to be. The other kind is variable interest rate, and that is just like it sounds. It's going to change, and it could change every month. It could change every quarter. So once every 3 months, it could change every year. It really depends on, once again, the details of that loan. So again, that might go up or down depending on the market. Some people like that because oftentimes variable rates may be lower than fixed interest rates, and people like to sort of take that chance and see if they can pay less and maybe pay off their loan early, or just pay less interest on a lower variable interest rate. But again, it can go up and it can go down. For a variable interest rate, they may have caps on that interest rate. And what that means is, you've got a variable interest rate, could go up or down. If there's a cap on it, it's not going to go above that cap. So if your cap is 9%, you could be anywhere between 0 and 9%, but it can't go above that. Most interest rates that you're going to get most interest rates are tied to the strength of your credit. So what that means is that it's very rare that you would see a loan that says the interest on this loan, if you apply and are approved for this loan, is 7%. What you're probably going to see is a spread. So it should say, okay, you will get anywhere between 4 and 10% on this loan, for an example. And based on your credit, if you've got really good credit and a high credit score, you're going to pay a lower interest rate. And if your credit score is in the middle, you're going to be somewhere in the middle. And if it's not so great, it might be a higher interest rate that you're charging. So that's how MEFA does our loans as well. We have what they call credit tiered interest rate. So the higher your credit score, the lower your rate. And I think, I can't think of anyone off the top of my head, any educational loan lenders that do it differently than that these days. And then also the interest rate may be tied to your chosen repayment option. And we'll talk about that in some detail, but basically, I can tell you from experience from MEFA's loans, we have different repayment options. So we have a loan where you begin repaying immediately when you enter college, and that loan is dispersed to the college. You're going to start repaying while you're in college. Sometimes you might have a loan that you're only paying interest on while you're in college, and then you'll pay interest and principal when you leave. Or sometimes your repayment is totally deferred until after you're out of college. And each of those options might have different interest rates associated with them. It does for MEFA. So that is on interest rate. So APR is the annual percentage rate. It's sort of another way of stating the interest rate. It takes into account not just the interest, but any fees that are associated with the loan, and the annual cost of borrowing that loan. So it's expressed as a percentage along with the interest rate. And it's a quick way to compare between loans, maybe fixed or variable rate loans. But I think when you're looking at different loans, there are ways to, we're going to highlight a loan calculator that's on the MEFA webpage, and most lenders will have loan repayment calculators. You can go and check the interest rate, the repayment term, how much you're going to be paying every month, and overall what it's going to cost you. So there are definitely ways to compare loans that would make sense. Now, I mentioned repayment term just a minute ago. It's the sort of other really important thing when it comes to comparing loans. So you have interest rates on one hand, lower interest rate is good, fixed versus variable rate is up to you. The other thing is repayment term, and the repayment term is how long it's going to take you to repay that loan. So some loans have repayment terms of 10 years, 15 years, 20 years, and it depends, because generally speaking, the longer you take to repay a loan, the more interest you're going to pay. And so it's always a good idea, if you can, to repay loans as quickly as you can, because you're going to be paying less interest then over the life of the loan. However, loans that have a longer repayment term might have lower monthly payments. And it might be worth your while to get one with a longer term and a lower monthly payment, and maybe you can prepay a loan. So the loan payment that you have to pay every month is low, but you can pay over that if you're able to do it. And if you can prepay a loan, it's good to know if your loan has a prepayment penalty. I don't know of any educational loans that do, frankly. MEFA doesn't, we never have. And I haven't really heard of educational loans that have prepayment penalties, but it's the kind of thing that you don't really want to assume. So it's a question that you can ask a lender when you're looking at loans is, do you have a prepayment penalty? So it might not be a bad idea, once again, as I said, to make your monthly payment low and try to prepay and pay down the principal early. Now, most lenders will have different repayment terms to choose from. As I said, MEFA has 10-year repayment terms and 15-year repayment terms with no prepayment penalty. Other lenders may have different amounts as well. So it might be 10 years, might be 15 years, and 20 years. Those federal loans, which we'll talk about, are very flexible in the amount of time that you can take to repay those. So you can stretch that term out and set the monthly payment low for you. But we'll get to that in more detail when we talk about federal student loans. And I see somebody joined us. So if you have any questions, be sure to submit them into the chat or the Q&A. And, if you missed something I said, I'll go over it again. If you have questions or something I haven't said, you can ask, and I can try to address that. Okay, so interest rate, loan term, an application and solicitation disclosure. This is a form that is required to be provided by any lender. It's a federally mandated form. And basically what it does, it is a statement providing the details about the loan and the estimated total cost of the loan. And it'll give you some examples. So I'll show you MEFA's. Oh, goodness. Couldn't get there. Let me try again. All right, why don't I go? Because I want to kind of show you here. But it's every lender is required to have it. When we were doing things in person way back in the day, and we had a table with brochures and things like that, we used to have our application and solicitation disclosure agreement. So again, I'm sorry, you may have to see my desktop. Oh, no, we can do it. Okay, I'm going to go to MEFA. And I'll pay for college, MEFA loans. Okay. And our application, solicitation, and disclosure agreement should be right here under disclosures. Yep, here it is. Okay, so this is information. Well, can you actually see? Can somebody let me know if they can see this application and solicitation disclosure agreement? Or are you still stuck on the
No, we can see
PowerPoint?
it.
You can see it? Okay, good. Thank you. So yeah, so this refers to all MEFA products. So this is the interest rate spread for all of our products here, which is 3.75% to 5.75%. And so what this gives you, a logo here, so your interest rate upon approval will be somewhere in here. Your interest rate is fixed for the life of the loan. Your rate is fixed, and this means that your interest rate will always be the rate listed on this form and in the MEFA loan agreement for this education loan. And so what this does, this is going to assume, just as an example, that you're borrowing $10,000. You see here, loan fees, application fee, none, origination fee, none. An origination fee is something that used to be more common than it is, but it's basically a one-time fee that is part of the loan. Late charge, so a charge for late payment, none. Return check charge, none. And fees, none. So we don't charge any fees at all. Now you see here we have 5 different repayment options. We have an immediate repayment option, pay both the principal and interest amounts while the student is in school. The highest interest rate possible is what you're going to get over here. So not the lowest, but the highest. And the highest possible interest rate, I'm sorry, I'm going to admit someone else here, is 5.4%. This loan term that you have to repay is 10 years. So if you're borrowing $10,000, you have the highest interest rate possible, and you're paying 10 years starting while you're in school with this particular loan. The amount that you're going to pay over the life of the loan is $13,142. So it's an extra $3,142 from the $10,000 that you borrowed. Now, if you have a $10,000 loan and you're borrowing this 15-year repayment term, remember your monthly payments are going to be lower. It's not reflected here, but your monthly payments will be lower. The highest possible interest rate is slightly higher here, 5.45%. And you can see that results in a slightly higher, again, interest over the life of the loan. So again, $14,864, that's an extra $4,864.40 for borrowing $10,000. There's this third option here, which is an interest-only repayment. So you're paying only the interest while the student is in school. So you're in school and you're starting to get billed, but you're only paying the interest. This is a 15-year repayment term. When you leave school, you're going to start paying interest and principal. Your highest possible interest rate is 5.65%. And again, this is going to be slightly higher on the interest, an extra $5,937.32 on the $10,000 that you borrowed. Your deferred repayment, so this is you're not expected to make any payments at all while you're in college, and your repayment begins 6 months after you graduate, leave school, or fall below half-time status. So this is 5.6% is your highest possible starting rate, interest rate, and you're going to pay an extra $6,547.52. And then the highest cost loan here that we have is another deferred repayment, and that's a 15-year repayment term as well. The difference between this deferred repayment and the last deferred repayment is that on this one, there is an option where if you pay the first 48 monthly payments on time, co-applicants can apply to be removed from the loan. And if the student borrower is creditworthy at that time, that can happen and the student can take over. And that is the highest, as I said, the highest cost option really that we have. The interest rate, the highest possible interest rate is that 5.75%. And the total estimated interest over the life of the loan is going to be an extra $6,756.08. So I think 2 things should jump out at you. The first one being, we've gone from least amount of interest to most amount of interest here. And so the principle being that if you are beginning to repay immediately and you take a less amount of time to repay, you're going to be paying less over the long run. The other thing I would say too is that these are estimates. So these deferred loans, interest is accruing on them while you're in college. And you can make payments on that if you want. You don't have to, but we're assuming in these examples here that you're not making extra payments, that you're just paying what's due when it's due. But if you were to pay earlier or more, these overall numbers here, the total paid, are going to be lower than these estimates are. But this is, I mean, I think you can see the point of this here is to give you an idea of what the lender's offering. So what interest rates might we get from this lender, what type of programs, and how much would borrowing cost us? So this is, again, a federally mandated form. Everyone's mandated to have this on their website or to offer this. Should be easy to find. And we'll take a look at some other forms as well. So you saw this one. Okay, so here's some other examples of different lenders' application and solicitation disclosure agreement. So this variable rate, this is a variable rate loan disclosure. And so the first thing I want to draw your attention to here is the much larger spread here. So the loan interest rate and fees, your starting interest rate will be anywhere between 3.75%, exact same floor as MEFA, and 10.125%. So it's a much larger sort of latitude there between the highest and the lowest. And there is a cap here, but it's very high. So although the rate will vary after you're approved, it will never exceed 25%. And 25% is the maximum allowable for this loan. We see here there are no application fees, no disbursement fees, a late fee of 5% if you make a late payment of the past due amount, up to a maximum of $25. So you're not going to be charged more than $25. And there is a returned check fee of $20. Now at the bottom here, you can sort of learn a little bit about this variable interest rate. So the variable interest rate is based on a publicly available index, which is the LIBOR rate. So these things frequently are tied to either the LIBOR or the prime rate. And these are rates that are set on a sort of varying basis. So if this one is the LIBOR rate rounded up to the next 0.125%, and your rate will be calculated each month by adding a margin between 3.5 and 9.875% to the LIBOR. So it's going to change every month, and it's going to be based on the LIBOR plus 3.5 or anywhere from 3.5 to 9.875. The rate will not increase more than once a month, but there's no limit to the amount that the rate could increase at one time. So it could go, I mean, there's a cap of 25%, but theoretically it could go, from 4% to 25%. That would be extreme. I've never seen that, but that's just to let you know that that is possible. Okay, now here's another fixed rate example. So your starting interest rate will be anywhere between 6.53% and 12.19%. The maximum rate on the student loan is the fixed rate, which will be disclosed to you if you qualify. So oftentimes you don't know the rate that you're going to receive until you apply. And as I said, that's the case with MEFA as well. But it's common to see a range like this and you don't know until you apply. So I just want to draw your attention over here as well. So there are loan cost examples. And again, you see it's sort of like the MEFA where they assume $10,000 for their different products. And on the deferred repayment, it's $10,000. The highest possible interest rate is 12.19%. The loan term is 15 years starting after the deferment period. And the total paid over the 15 years, including fees and interest that accrues, is $32,482. So if you're borrowing $10,000, you're paying the highest interest rate, you're deferring it, you're going to pay an extra $22,482 on that amount. If you're paying the interest only, it's $26,476. So another, $16,476. And if you're making full payments right away, interest and principal, it's $21,230. So another $11,230. And so you can see there's quite a difference there between deferring paying interest and making full payments right away. It's a big difference between paying $21,000 over 15 years and paying $32,000 after that same amount. So I don't know if anybody has any questions on this so far. Okay, I want to keep going. So, it's important to talk about the co-borrower because the way student loans are generally understood, and I say student loans because you read about student loans, people talk about student loans, and since they do, they tend to think that students can just borrow whatever it might be that they need as long as they promise to repay it after college, and they're stuck with these huge amounts on their own. But the fact is that students generally can't borrow on their own without a co-applicant, except for one program, and that's that federal direct student loan program, which we'll talk about in detail. So, and those loans have loan limits associated with them. They're part of the financial aid offer to begin with. So if you're accepting your financial aid, including those loans, and then you have a balance to finance through borrowing, those student loans are already part of it. Any loan that you get in addition to those loans are probably going to have to be credit approved or credit and income approved. And most traditional students need a co-borrower to be approved. And a co-borrower typically is the one whose credit their loan approval is based upon. They need to sign the loan agreement, the promissory note, the loan agreement promising to pay back the loan along with the student borrower, and has equal responsibility to repay. And that's something that really needs to be understood because I have talked to many, many parents over the years at MEFA. And MEFA is a family loan as well as a part of the student and the parent have responsibility on that loan. But I've talked to many parents or other people who have signed loans and say, but it's not really my loan. It's really his loan. I'm just a co-applicant. But if you're on the loan as a co-applicant, it's your loan too, and it's going to show up in your credit report, and you're going to be responsible to repay that loan as well. Now, adding one or two co-borrowers may increase your chances for approval. I know for MEFA, we have a space for the student applicant, and then we have the space for two co-applicants. You don't have to have two. Somebody on the loan needs to be credit worthy and sort of have income necessary to be approved. We will take the highest credit score on the loan as the one in which we base the decision. So if you're in a situation where you're applying for a loan and they have credit tiered interest rates, and you have somebody with really good credit as a co-applicant, that's going to help you get a lower rate or get approved. So, and the other thing is, and I mentioned this as another MEFA product, some loans do have co-borrower release options. It's definitely something you want to check on and make sure you know what the co-borrower has to do in order to be removed from a loan. A lot of times people just assume that, it's a year's payments and then you're off, or it's as soon as the student's out of school, you can come off. Just make sure you know what the requirements are so you can meet those. As I said, for MEFA, it's the first 48 consecutive on-time monthly payments. That's also a deferred loan. So repayment doesn't begin until after the student graduates or leaves school. So if you have a incoming freshman and you're a co-borrower on one of these loans that you can get removed from, you're waiting for 4 years while the student's in school, then making 4 years of repayment, and then the student has to apply and be approved to take on the loan by themselves. So, just make sure if this is something that is attractive to you or to your co-borrower, make sure that you are familiar with the terms so that you can go ahead and do that when you want to. Okay, so now we move on to the second part, which is to be a wise borrower. And so, as I said, some of this stuff may be relevant to you or more relevant to you than others. But the principle here to minimize borrowing is to use other sources before you get to borrowing. In this example here, is a $20,000 balance due. And we're sort of assuming here in this case that it's a $20,000 balance due. And again, it may be much less than that. But in this case, what we're highlighting really is that after financial aid is taken into account, there are basically three ways that you can pay your balance. The first one is past income, meaning any savings that you may have. So, or assets that you can leverage. The second way is present income, which is your current wages. And, as I always say, I don't know if I know anybody. I may know, maybe I know one or two people, I don't know, but who can pay for a year of college or a semester of college just from their wages. But it is worth it to pay what you can out of pocket. Most colleges work with an outside provider to offer interest-free monthly tuition payment plans. So you sign up for a small fee, usually over the summer, and whatever you can pay on a monthly basis, you can pay that, and it goes against tuition. So I guess in this example here, we've got $5,000 that we've taken care of for savings, and then let's say this person decides that they can pay $500 a month. It's more than I can afford to pay, but in this example, they can. Over 10 months, that's $5,000 straight off paid tuition that they don't have to borrow, they don't have to pay interest on over the next 10 or 15 years. Because once you do exhaust financial aid and savings and current wages, the only thing left is loans, so your future income. And as I said at the beginning, most families or students probably will end up borrowing something to get through a few years of college. But I can tell you from experience just working at MEFA that there's a big difference between borrowing $20,000 and borrowing $10,000 for 1 year of college. And that's the other thing you want to keep in mind, that this is a yearly proposition. So, just sort of back of the envelope kind of math, if you borrow $20,000, that's probably a $200 a month monthly payment. Whereas if you borrow $10,000, it's a $100 a month monthly payment. Again, not that 100 is a drop in the bucket, but it's going to be important after 2 or more years. Okay, now we're talking about federal direct student loans. The other thing we always say, if you're going to be borrowing, start by taking your federal direct student loans first. These are the only loans, for the most part, that most undergraduate students are going to be able to get without a co-applicant, because there was no credit check to be approved. You file your FAFSA, and unless there are some two very specific circumstances that I can think about, you're basically eligible for these loans. These are fixed interest rates, so they change annually because you're going to get different loans every year. But for your freshman year, you're going to get your federal direct student loan, and that's going to be, this upcoming year is going to be for 3.734%, and that's always what it's going to be. Next year, when you file your FAFSA and you get your federal direct student loans, they're going to have their own interest rate, and they're going to be fixed at what they are. And it comes in two types. So there are subsidized federal direct student loans, and there are unsubsidized federal direct student loans. And what this means is that these loans are deferred, meaning you're not expected to make any payments on these loans while you're in college and in classes. On the subsidized portion of this loan, there's no interest that is being added to the amount that you borrowed while you're in college and taking classes. The government's paying that interest. For the unsubsidized portion, there is going to be interest that's adding to that. You don't have to pay that while you're in college. You can, you don't have to. So subsidized and unsubsidized, and how much you get of each is going to be determined on your financial need. And when you file your FAFSA, when the college takes a look at that, and that's going to be part of in your financial aid offer, you'll get an amount that says subsidized maybe and says unsubsidized maybe. So, or it might just all say unsubsidized. It really depends. There's an origination fee for this particular loan, and that is a 1.057% fee, and it's deducted from your loan amount. So if you take a look over at the right here at the annual loan limits, this is the amount that you're allowed to borrow on your own as an undergraduate student through these loan programs. So for your freshman year, you're eligible to borrow $5,500 through these programs. Sophomore year, that goes up to 6,500, junior year, 7,500, and senior year, 7,500 again. So for the origination fee, you got 5,500. When it gets dispersed to the college, they take out that 1.057%, and you're left with 5,441.87. So that's really all that means. So as I said, once you file your FAFSA, you're generally approved for these loans, but you have to go through entrance counseling and sign your master promissory note, and you do that on studentaid.gov, and you have to do that before you can get those loans. Now, as I said before, there's no payments while you're in school. You can make payments if you want, you don't have to, but on top of everything that I've said, really, to me, I always think of the biggest reasons why students should take these loans, and these loans are student financial aid before other loans, is that there are a lot of repayment options for these loans. So they're very flexible in how they can be repaid. First of all, as I said, they're deferred. They don't start repaying until 6 months after the student leaves or graduates. If you decide to continue your degree at a four-year college or grad school or wherever it may be, you can put these loans back into an in-school deferment. If you take all of these loans, so 5,500, 6,500, 7,500, and then 7,500 the senior year, in your name, you're going to leave with about $27,000 in federal direct student loan debt. The standard repayment term for that is 10 years. So at 10 years, with that amount at around these interest rates, you're roughly looking at about a $300 a month monthly payment. So if that's manageable, great. If you'd like it to be lower and you can get it lower, you can do that. There are any number of repayment plans you can get on to lower your monthly payment. You can stretch out the repayment term to 20 years, 25 years or more. Make that monthly payment as low as 10% of your discretionary income every month. There are public service loan forgiveness options where if you're on one of those longer longer repayment terms, and you work for a qualified nonprofit for 10 years, you can have the balance of your loan forgiven at that point. There are there are hardship forbearances, deferments, just a lot of flexibility in how these loans are repaid that just aren't available with other types of loans, non-federally guaranteed loans. So again, this is why we say you should start by taking these loans if you're going to borrow anything, and why these loans are considered financial aid. Now, understanding how loans work, not in, you borrow and pay it back, but how these educational loans work. So as I said, you have financial aid. That takes up hopefully a good amount of your bill, but you may still have a balance due after financial aid. So you can borrow a loan amount up to the school's cost of attendance minus any other financial aid received. Just using MEFA as an example, we really lean on the school to sort of say, this is how much they're eligible for. You have to go and say, there's a form called the self-certification agreement, and you list your cost, you list your aid, and then you subtract the aid that you received from the overall cost, and whatever's remaining, you shouldn't be borrowing more than, but only borrow what you need. So if you can borrow up to the full cost minus any other aid, but you should only borrow what you absolutely need to borrow. So as I said, exhaust those other options first, whether that's savings or your current wages or scholarships that you may apply for. And try to cut down your costs if that's possible. That you're going to incur as a way to minimize borrowing as well. A lot of people want to know if they borrow for 4 years or 2 years at once, you borrow on a yearly basis. And so everything here paying for college really is done on a semester or a yearly basis. So you have to file your financial aid forms every year. You're borrowing on a yearly basis. You can borrow for one semester at a time. You can borrow for a year at a time. And basically the way it would work with MEFA, at least, is you would borrow through MEFA. And generally speaking, you borrow through the lender. You fill out your application. You request the amount that you're looking to borrow. And they do a credit check or a credit and income check, and they get back to you with their decision. Now, assuming that they're approving you, what happens then is you need to sign the promissory notes or the loan agreements. And then the lender gets in touch with the college, and the college verifies that the student is enrolled or will be enrolled at that college for the year that which they applied, the loan period which they applied for. And then they say, yes, they're enrolled, they're eligible for this amount of money, and send it to us on this date or this date and this date. Sometimes if you're applying by the year, typically colleges will say, give us this amount for the fall and this amount for the spring. And those are your disbursement dates. You can estimate your monthly payment, and there's the calculator that you can do that with on the MEFA site that we'll look at. Think about your total loan repayment. So at the loan calculator that we'll look at is for a year, and because that's this year's loan product, and we disperse on a yearly basis, and we don't know what it's going to cost in the upcoming years or how much exactly that you'll need. But one thing you can do is take a look and see what your loan monthly payment would be for this year, and maybe multiply that by 2 or 4, and however long you're planning on being in college, and see if that's something that you can handle. Is that something that's going to be okay, and you can finance that? Consider your projected salary, of course, and any estimates, but it is something that you want to take a look at before you start to borrow and before you start sort of accumulating the educational loans that you're going to have to repay. Oh, and here we are. I'm assuming this is not going to work this way either, but I'll try it now. Okay. So I'm going to go ahead here and try to get out and go to the repayment calculator. So let's see this here. Oh, we're right up here, monthly payment calculator. Okay. So let's assume again that we're going to borrow $10,000 years before graduation. Let's say it's 2 years before graduation. And since we're a credit tiered profile here, then we have to pick if we have fair credit, good credit, or excellent credit. And I think it's a good policy to just shoot right from the middle there and say good. And what do we got here? Let's try that. Okay. All right, let me try it somewhere else. I'm trying it here. Might work on this one. Okay, let's try it here. Okay, we'll do 10,000 again. We'll say good again. Graduation again. Okay. Here we go. Okay. So these are our monthly payments. 10 years, and again, we're going to go from, well, not necessarily, but well, I was going to say we're going from lowest monthly payments to highest, but we're not really. We're going to go from lowest overall cost to highest. So, but this will tell us here what our monthly payment is for in school and out of school. It's going to be the same here for $106.19 for 10 years, interest rate 4.85, and total loan cost of $12,742. This is a very similar, but it's a 15-year repayment. So the monthly payments are going to be lower. So we're at $79.47 a month. Total loan cost is going to be a bit higher because we're taking longer to pay it off, and the interest rate's just a touch higher. Interest only, while we're in college, it's going to be only $44.56 a month. When we start to pay interest and principal, it goes up to $89.63 for the remainder, and then the total cost is $15,051. And then our deferred repayments, again, we're assuming that no prepayments are being made. All of the interest now is accruing throughout our deferment, and all that interest actually gets added to the principal when the loan begins repayment, and it becomes part of the principal. So if you can pay interest off before that happens, it's going to have an outsized effect on the amount that you're going to be paying overall. It's a good thing to do, basically. You're not required to do it, but anything that you can pay ahead of time is good. Again, monthly payment, $99.44. Total loan cost, $15,512. And then for student deferred with co-borrower release, slightly higher interest rate there, 5.5 versus 5.35. So it's going to be a little bit higher, about $1 more actually every month. And that's going to turn into 15,693 over the long term. So this is for 1 year. So make sure you multiply that by 2 or 3 or however long you plan on being in college for. And that's something that you can comfortably handle as a payment. And that's MEFA's calculator, but other lenders will have their calculators as well. Okay. So advice from trusted resources, ask questions of lenders for sure. Look for transparency. How easy is it to find the information that you're looking for? What is the interest rate spread? What are the policies on late fees, late payment fees, etc.? How easy is it to find their application and solicitation disclosure agreement on their website? Utilize free resources, including MEFA, including TRIO, including other organizations like ASA, which is the American Student Assistance, which is a student advocacy group. Definitely work with college financial aid and student accounting offices. We talk about this all the time. The financial aid office is a resource for you. So keep in contact with the financial aid office. I know everyone here would say the same. They're here to help you, and they can't help you if they don't know what's going on. So definitely take advantage of them as a resource. Being aware of timing, I don't think is, probably not that timely, ironically right now. But connect with us on social media. So we have a lot of info that we're always posting about, particularly scholarships and events that are occurring. There's all our social media information there. And definitely, as I said, think of us as we are a free resource. That's the phone number that you can call us at any point during the day. 9 to 5, we're open. You can email us at collegeplanning@mefa.org. We'll definitely get in touch. We're here to help you. So don't think that you're taking us away from our jobs, because this is essentially what we're here to do. So hopefully you found this helpful. And if you have questions, as I said, don't be afraid to reach out. Your TRIO office, Angela in particular, has my email. She can pass along questions that folks may have, and do not, again, feel shy to do just that. Otherwise, I'm going to stop sharing my screen. And that was me.
Awesome.
So if
Thank
anybody
you so
has any
much,
questions.
John. This was
Sure.
really, it was really informative. I think I speak for all of us when I say looking at the breakdown of, the different repayment options was really enlightening, and that'll certainly be helpful for students. So I really appreciate your time tonight.
Thank you.